Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're talking about some of the best sportswear and sports-related stocks to consider buying as we head into the really juicy part of Q2 earnings season, which really kicked off yesterday unofficially. But before we do that, I want to remember if you have any questions or episode suggestions, please feel free to shoot us an email over at podcasts@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. All right, so the S&P 500 hit another all-time high and closing high on Friday as investors continued to price in the likelihood that the Fed cuts interest rates, plus positivity still seems to remain relatively strong on the U.S.-China trade war front. This growth continued on Monday with the S&P hitting 3,017 near 3,018. So some strong start to July, the second half of the year. And in fact, the markets are on track for their third best year since 1990. This would be trailing only 2003 and 2009. And then, as I mentioned at the top, Monday kind of marked the unofficial start to the second quarter earnings season, with the big banks starting to report, others reporting today as well. Overall, we have more than 140 companies set to report their quarterly results this week. This list also includes nearly 60 S&P 500 members from IBM, Microsoft, Netflix, United Airlines, and many more. With this in mind, total second quarter earnings season for 2019 for the S&P 500 index are expected to be down 3.4%, and this is based on our Zacks consensus estimates, all mashed up into one from the year ago period. And then this is with revenues expected to be roughly 3.9% higher. And this would come after earnings declined 0.2% in the first quarter on the back of 4.5% higher revenues in Q1. So with this all in mind, as we ramp up Q2 earnings season, I figured it's time to look at some stocks that are currently Zacks number 1 or 2 ranked buy stocks that are in this realm we talk about on the Full Court Finance podcast that are reporting earnings within the next few weeks or even the next month or so as Q2 earnings season starts up. So we're going to start with Skechers USA. It's trading under the ticker SKX. The stock is currently a Zacks rank number 2 buy with a B grade for momentum in our style score system, and it is set to report its quarterly results later this week. But before we jump into why SKX looks strong, it's helpful to remember that President Trump in decided to renew trade war negotiations to hopefully end the ongoing U.S.-China trade war. But more importantly for these footwear companies we're going to talk about is that the countries didn't roll out new tariffs in what would amount to kind of a ceasefire at the moment. And these are what those tariffs that would have rolled out had there not been a stop to that, were what the footwear industry was really worried about, that they would hurt their business and what they said would be their customers. So that's just worth mentioning as we head into all of these companies, that at the moment, these consumer side businesses, consumer focused businesses, don't have as much to worry about on the trade war front just yet. But obviously anything could change either on the positive or negative side. So at the moment, Skechers seems to be what I always thought of Skechers is lower priced footwear. They now sell everything from golf cleats to boots to in between shoes. They also sell apparel. But I had always thought of the company selling what I thought was really, really cheap. Not cheap in the sense that they're not quality, though I've never owned a pair of Skechers. But when I was perusing their website last night, it's not necessarily as cheap as I thought it would be. So their average sneakers / just sort of streetwear shoes cost between $70 to $75 for men, with some pairs of their running shoes costing as much as $125, with their golf shoes running $130. And that is certainly not the price point I thought they were at. I mean, obviously, if you're a follower of Skechers, you would have a better understanding, but that's not too far off some of their, what I would consider higher end competitors like Adidas or Nike, especially if you're going to the outlets. Just for a frame of reference, though, so Nike's running shoes, if you are on their website, the new one started around $120. So that's compared to uh, 70, 75. But they do, as I mentioned, Skechers does have shoes that are running at that same Nike price point. But then Nike can jump way beyond 250 and way farther than that, as we've talked about that show on this show before on that secondary market. But that's just kind of an aside to give people a sense that Skechers isn't necessarily that really, really cheap brand that some people might have thought it was. They gained traction over the last year a little bit as that ugly shoe craze kind of hit the fashion world, and that doesn't seem very sustainable in the long run, which I think is kind of a good thing for the company itself, since they're much more than just the few popular quote unquote ugly shoes that gained traction last year. So as of February 2019, this is the most recent numbers they provided. The company had more than 3,000 company-owned or third-party-owned retail stores across 170 countries. So, and they also have a pretty significant wholesale business. Last quarter, the company posted record revenues of $1.28 billion. This was up 2.1%, and then they mentioned it's up over 5% on a constant currency basis. International sales were up big, so that's a big growth aspect of Skechers' business going forward. International sales were up 9.3% and 15% on a constant currency basis. And then taking a step back to give people a sense of where Skechers has been recently and over the last several years, SKX stock is up 123% over the last 5 years, which is far higher than the apparel market's average of roughly 50%. And the stock is also up 5% or 50% in the last 3 years. Sorry. Now I butchers his numbers, so please forgive me. The stock is up 5% in the last 3 years. So lots of stagnation, almost sideways, with that big 123% jump happening at the beginning part of that 5-year look back. But then in 2019 so far, the stock is up 50%, which has crushed the S&P 500, which is only up 19%. SKX stock then closed up Monday roughly 0.5% at $34.26 per share, which is just roughly $1 below its 52-week high. So it's near its 52-week highs heading into earnings. So now let's quickly look ahead to what to expect from the company. So at the moment, our Zacks consensus estimates are calling for roughly 7.3% revenue growth to hit $1.22 billion. And then on the bottom line, our estimates are calling for nearly 14% bottom line growth to hit 33 cents per share. And then overall, 3 out of the last 4 periods, Skechers has topped our earnings estimates with some relatively impressive beats mixed in there. And then at the moment, in terms of its valuation picture, Skechers is trading at a price to sales ratio of 1.2, which comes in a little bit above the industry's 0.8 average, but it's not crazy compared to the S&P 500 at the moment, which is at 2.6. And then Skechers is also trading at a roughly 17 times forward Zacks consensus earning estimates, which is also slightly above its industry's average, but that can also be blamed on its massive 50% climb so far this year. So as I mentioned, the stock is currently a number 2 ranked buy stock, and they are set to report their Q2 financial results after the market close on Thursday, July 18th. So it's definitely a stock to consider at the moment as Q2 earnings season ramps up. And now we're going to move on to another company I've talked a lot about at the show, but we're always getting new listeners, so it's always worth bringing up sort of the same big companies because the stock has been booming. So there's no point in talking about a stock once when it's doing well and never talking about it again. So this is a stock that I've sort of taken the opposite end of how it's trending now, because I think the business isn't necessarily the most growth-focused company for the long term. But at the moment, for the next several years, or so, the stock itself looks to be very strong in terms of its metrics and its fundamentals, and that is Under Armour. It is currently a Zacks #1 strong buy stock, and it is projected to see its fiscal 2019 and 2020 earnings jump in a big way, which is a big reason why it's currently a #1 strong buy stock. And as I mentioned, I don't really want to get into all the reasons why I think it's not necessarily the strongest position of these sportswear companies, especially compared to the likes of Nike and Adidas. But what has been good for the company is that they're amidst of a restructuring program. They're trying to streamline their business, get to market quicker, lower some of their actual product offerings, so they're just not offering as much. And the stock, as I mentioned itself, is doing very, very well. The stock popped nearly 0.8% on Monday to hit a brand new all-time or brand new 52-week high of $27.69 per share. The stock is now up 55% in 2019, which once again crushes the S&P 500 and the apparel market's 22% average and Nike. So Under Armour's up 55%, hit a new 52-week high on Monday. But it still has a really long way to go before it climbs back up to its late 2015 highs when it was trading at around $50 per share. So it's done really well in 2019 so far, but a long way to go to get back to where it used to be. But now let's look ahead to why it's currently a #1 strong rank buy stock on Zacks. Our current estimates are calling for roughly 2% revenue growth in the current quarter, with earnings expected to jump from a loss of 8 cents per share in the year ago period to another loss, but a slightly smaller loss. So that's good bottom line growth. But then it's the fiscal 2019 and fiscal 2020 is where that positivity is really coming from for Under Armour. So we're calling for roughly 3.7% top line growth and then 30% bottom line growth, all the way up to 35 cents per share for the full year, and then an additional 43% bottom line growth that next year, with revenues expected to jump 6% above our current year estimates. So it seems like their restructuring plans will start to pay off heavily at the end of fiscal 2019, and then really starting in fiscal 2020 is when they look to be strong again. In this growth on the top line would beat last quarter's growth. So an impressive stuff for Under Armour, which is trading under the ticker UAA, for those of you who do not know. And then, as I mentioned with Skechers, we're going to talk a little bit of valuation at the moment as well, because it's always worth mentioning that when you're considering a stock at any moment. But since it's gone up so big, 55%, in 2019, it's definitely a company that people need to be thinking of in that growth aspect, where people are going to kind of ride this stock up as the earnings turn back around. Maybe it can slowly see if it can climb back up to where it was in 2015, but we'll see about that. So at the moment, Under Armour stock is trading at 64 times earnings, which marks a pretty huge premium compared to the industry's 15 times average. But it has traded as high as almost 100 times over the last 3 years, so a little bit less than that. But as I mentioned, it's still definitely a growth-focused stock at the moment. And then Under Armour is expected to release its Q2 earnings results on July 30th, so at the end of the month. So it's definitely a stock to consider looking at as we head into its earnings release at the end of July. But now I want to end on a stock that I've been very high on for the last several years, and it continues to be a highly ranked stock on Zacks, and it continues to be outpacing its industry. And it's a company, as I mentioned, just like Under Armour, I've talked about a lot, but that doesn't mean I can't continue to talk about it, because it's a stock that just continues to please the investors who have bought it already, and can make some people happy if they jump on it now, no matter what. So that is Lululemon. Its rise into a sports apparel powerhouse has been so widespread that it's kind of created this whole athleisure industry. It's pushed Nike and Adidas and Puma and Gap and even L Brands, Victoria's Secrets, and all these other companies to really jump deep into this athleisure business, and Lululemon is not stopping there. They're now competing kind of on a way bigger scale, on the same level as maybe even Nike in terms of what they're offering. They're now offering winter coats. They're offering more work-focused clothes. They're starting to sell more men's clothes than ever before. They're trying to double their size of their menswear revenue by 2023. They're also trying to double the company's digital revenues and quadruple its international sales over the next 4 years. They're rolling out self-care products. They're just doing pretty much as they possibly can to expand, but without sort of cheapening their brand, because it still is that high-end brand where they're selling things for $150, $200, and people are still gobbling it up. So I want to quickly look at what they did last quarter to put into perspective for what we're predicting going forward. So they ended the first quarter with 455 stores around the world, and they kind of started as more of a direct-to-consumer business, which is perfect in this Amazon age where Nike and Adidas and all these other companies are slowly trying to focus less on wholesale and more of their own direct-to-consumer businesses. And then overall, Q1 revenues were up 20%. Comp sales, when you take into account e-commerce growth, was up 16%. International revenue was up nearly 40%. Digital up 35%. So some strong growth there for for Lululemon. And then, as with Under Armour, the stock is up really big so far in 2019. And as with Under Armour, it hit a new 52-week high on Monday. So as we start Q2 earnings season, both Under Armour and Lululemon and even Skechers are all right at their new 52-week highs. Lululemon stock is now up roughly 50% in the last 12 months and 56% so far in 2019. And now I quickly want to look ahead before we wrap up this episode. So right now, our current Zacks consensus estimates are calling for roughly 16% top line growth, which is expected to push up the bottom line by 24%. So some really strong earnings growth. And then all these estimates for Lululemon are trending in the right direction, which is also the case with Under Armour and Skechers. And that's why they're all highly ranked Zacks stocks at the moment. And then for the full year, we're calling for roughly 15.5% top line growth, nearly 23% bottom line growth. So some strong growth. And just for reference, that might sound like a little bit of a slowdown compared to Q1 when they had 20% growth. And it would mark a slowdown compared to 2018's 24% expansion. But 2018 crushed 2017's 13%, as well as 2016. So the company is maybe slowing down compared to its really, really impressive 2018, but it's still growing at a faster clip than it was even a couple years ago. So that's good news to see for investors. And as I mentioned, with the other stocks, Lululemon is currently a Zacks number 2 ranked buy at the moment, based in large part on its positive estimate revision trends. Its valuation metrics are definitely not as stretched by any means as Under Armour, but they're a little stretched at the moment compared to where they have been, but that's just based on their really stellar 2019 so far. So these are 3 companies to consider as we head into the Q2 earnings season, and Lululemon isn't expected to report until a little later in the Q2 earnings season. So they actually aren't expected to come out until the end of August, though we do not have an official date just yet. So still some time to look out through there. But as I mentioned, these are 3 stocks to consider. Q2 earnings season is heating up. And overall, the general trend is earnings expected to decline, where all of these companies we've mentioned expect to see their earnings kind of pop in a big way. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.